the calm that replaced belief. It looked like strength. It felt like maturity, and almost everyone trusted it. But beneath that calm, belief had already begun to slip away. To understand why this moment matters, we need to return to a phase when markets appeared unusually composed. Volatility was low. Reactions were muted. Headlines spoke of resilience and adaptation. The chaos of earlier cycles seemed distant. Calm wasn't just present, it was celebrated. But calm and belief are not the same thing. Belief is active. It pushes back against uncertainty. Calm can be passive. It simply absorbs whatever happens without resistance. And over time, that distinction becomes dangerous. The first reveal begins with how participants interpreted stability. Calm sessions were taken as proof that risks were understood, that systems were prepared, that nothing urgent needed attention. Each uneventful day reinforced the idea that belief was intact, even as fewer people felt compelled to act on it. The second reveal emerged in participation. Capital stayed invested, but lightly. Exposure remained, but commitment softened. Positions were held, not defended. When small pressures appeared, the market didn't respond with conviction. It waited to see if response was necessary. The third reveal came when experience conflicted with feeling. Veteran participants sensed something missing. The market wasn't absorbing shocks with confidence. It was tolerating them. Moves resolved slowly. Recoveries felt procedural, not assertive. Calm had replaced belief as the organizing force. This is the most deceptive phase of any cycle, because calm looks responsible. It looks rational. It looks safe. But calm without belief doesn't stabilize markets. It suspends them. The market hadn't failed. It had gone quiet in a way that masked fragility. And what followed would reveal the cost of mistaking calm for confidence. When the next test arrived and belief was no longer there to meet it. As calm settled in, the market's reactions grew softer but slower. Price moves no longer snapped back with urgency. They lingered. They hovered. Each response felt measured, almost thoughtful. To many observers, this seemed like progress, a sign that the system had learned from past successes. The conflict emerged in what calm demanded. Calm asked participants to trust that nothing urgent was happening, that waiting was sensible, that action could always come later. And for a while, that trust held. Small disruptions passed through quietly. Volatility stayed contained. The surface remained smooth. But beneath that surface, belief continued to drain. Liquidity reflected this shift first. Depth was visible, but it felt temporary. Bids appeared only after moves had already unfolded. Support waited for confirmation before engaging. The market wasn't confident enough to lead uncertainty. It preferred to observe it. The tension deepened as this behavior repeated. Each uneventful recovery reinforced the idea that belief wasn't required. Calm alone seemed sufficient. Participants learned that acting early offered little reward, while waiting carried no obvious cost. That lesson spread quickly. Institutional desks adjusted accordingly. Exposure stayed on, but conviction didn't. Positions were maintained, not expanded. Risk wasn't challenged. It was monitored. The market functioned, but it did so passively, relying on the absence of stress rather than the presence of belief. Derivatives markets told the same story in quiet ways. Protection remained bid even during tranquil sessions. Skew refused to normalize. Traders weren't hedging fear. They were hedging the possibility that calm might not hold when tested. The buildup continued as correlations tightened subtly. Assets that once moved independently began responding together. Diversification weakened quietly. The system was becoming more sensitive, even as it appeared more stable. Veteran participants recognized the danger clearly. Calm is not strength. Calm is the absence of challenge. And without challenge, belief has nothing to prove itself against. It fades through disuse. The market was still calm, but calm had replaced belief as the organizing principle. And when belief leaves, the system becomes dependent on conditions staying easy. The next phase would show what happens when conditions finally ask for more than calm, when the market needs belief again and discovers it has already been spent. The first real challenge didn't arrive as a shock. It arrived as ambiguity, a piece of information that could be interpreted more than one way. In a market built on belief, ambiguity invites engagement. In a market built on calm, it invites delay. Prices moved slightly, then stalled. Participants watched closely, waiting to see if calm would hold. Buyers hovered. Sellers tested. No one rushed to resolve the uncertainty. The market behaved politely, but politeness is not strength. It is avoidance with manners. The conflict intensified as that hesitation repeated. Each small test reinforced the same pattern. Moves extended further than expected, not because pressure increased, but because resistance failed to appear. Calm had trained participants to assume someone else would act if needed. Liquidity revealed the cost of that assumption. Depth appeared late. Support arrived only after direction was established. Capital responded to certainty instead of creating it. The system had become reactive by design. The buildup accelerated when correlations tightened abruptly. Assets that usually offset one another moved together, amplifying movement. Diversification thinned. Calm had smooth volatility, but it had also aligned behavior. When pressure appeared, everything leaned the same way. Institutional systems reacted automatically. Algorithms reduced aggressiveness. Risk controls trimmed exposure. These responses were orderly, rational, and perfectly calm, and they removed even more belief from the system. The market was adjusting without anyone asserting conviction. Veteran participants recognized the moment clearly. Calm had done its job too well. It had convinced the market that belief was unnecessary, that stability could exist without commitment, that uncertainty could be managed by waiting. But waiting only works until it doesn't. As pressure persisted, the absence became impossible to ignore. Support levels failed softly. Recovery stalled. Each attempt to regain balance felt tentative. The market wasn't panicking. It was realizing it had nothing left to push back with. The calm that once felt reassuring now felt hollow. And in that hollowness, direction began forming, not through fear, but through default. The final phase would reveal what happens when a market built on calm is forced to confront reality, and whether belief can return once it has been quietly replaced. Reality arrived without urgency, and that was the most unsettling part. The market didn't shatter the calm. It exposed it. A broader move unfolded, measured, persistent, and unopposed. Prices adjusted not because fear took over, but because belief never showed up. That was the climax. The moment calm was asked to do the work of conviction, and couldn't. Support levels gave way without resistance. Not from overwhelming pressure, but from absence. Liquidity appeared only after direction was obvious. Capital that had waited for certainty finally acted, but only to reposition, not to defend. Calm had kept the surface smooth, but it had hollowed out the structure underneath. What became clear was uncomfortable. Calm had masked fragility by postponing decisions. It had trained participants to tolerate uncertainty instead of confronting it. And when uncertainty finally demanded engagement, the system had no belief left to deploy. As the move settled, explanations rushed in. Analysts searched for catalysts. Commentators debated narratives, but none of them captured the truth. Nothing new had happened in that moment. The outcome had been forming quietly for weeks. The market wasn't reacting to information. It was reacting to the absence of belief. The resolution unfolded gradually. Volatility normalized at higher levels. Participation returned selectively. The market found balance again, but it was a balance shaped by acceptance rather than trust. Calm no longer dominated. Reality did. The deeper lesson lingered beneath every trade that followed. Calm is not resilience. Calm is not confidence. Calm is simply what happens when nothing forces belief to prove itself. And belief, when unused, fades. Markets don't fail when they're noisy. They fail when they're quiet for too long. Because silence can hide weakness better than chaos ever could. Understanding this changes how stability should be read. Not as reassurance, but as a question. Is the market confident or just unchallenged? Is belief holding it together? Or is calm simply postponing the moment of truth? The calm that replaced belief wasn't a warning. It was the warning we learned to ignore. So what do you think? Are we confusing calm with confidence again right now? The calm